100 people that are joining us, and we're going to present some of the research we've been doing at Supply Chain Insight on supply chain excellence, the definition of supply chain strength and resiliency. For those of you who read our research, you know that we have not taken this topic lightly. And in fact, one of the things that we've tried to do is to harness information to drive new insights for supply chain leaders. Our focus is on independent, actionable, and objective advice for supply chain leaders. One of the things that we have found is that a lot of supply chain leaders are stuck at the intersection of operating margin, inventory turns, and customer service. And we want to provide insights to help people to unstick their supply chain and unleash the potential of the supply chain. Today, I'm joined by Abby Mayer, who does a lot of the work behind the scenes on the data that we're going to show. And Abby has been working tirelessly over the period of the last 2 years to mine the data, plot the charts, talk to supply chain leaders, and to try to gain some insights for a data set that's fairly large and complex. Welcome, Abby. Abby's joining us today from New Mexico.
Thank you. I'm happy to be here.
It's exciting to see this come about. Hi, Abby?
Yes.
And I'm also joined by Dr. George Runger and Bahar, who works with George, who have been doing some help with us to understand how we can apply advanced operations research methods to mine the data and to understand the patterns. George was introduced to me by Manny at Intel, and I'll give you a story because I think it's really appropriate for today. Abby and I had been working last year with some students from Waterloo University on some operations research methods, and we were cranking along, and we were feeling pretty good about what we were doing. And at a conference, Manny took me aside, and Manny is a great operations research mind at Intel, and he said, Laura, I just want to tell you, I think you need to talk deeper and think deeper about this topic, and I want to introduce you to George Runger. And it's just been a great experience working with George and his team at Arizona State University. Welcome, George. How are you doing today? So as we continue and we look at this topic, let's start with our point of view on supply chain excellence, and then we'll get into what we found in the last 2 years, and then we'll present the methodology that we're rolling out over the summer as we begin the countdown for the Supply Chain Insights Global Summit. It is our belief that the supply chain is a complex system with complex processes with increasing complexity. This has come to have deep meaning to me as I have first written the book, Bricks Matter, and I work on the second book, Metrics That Matter. What I see most supply chain leaders focusing on is understanding complex processes. What I see that they are not managing is increasing complexity that's throwing the supply chain out of balance. And what do I mean by increased complexity? It could be a wider product portfolio, it could be different materials, it could be global operations. But the concept around increasing complexity in the supply chain, as you'll see, has been an issue that many supply chain leaders feel that they can't quite put their hands on it, and they can't have the discussion at the boardroom about what it means. So what we have been trying to do is to understand the supply chain as a complex system, as a series of interrelated and interdependent ratios, and that each of the supply chain leaders have got to really put their muscle underneath those ratios to raise the potential of the supply chain. And that's what we've been studying. And our point of view on supply chain excellence is that you can't put all industries in a spreadsheet and shake them up. And you can't necessarily have a beauty contest. Instead, what we think that we've got to really analyze is which supply chains have performed better year over year than their peer group and have improved year over year results, and which organizations have aligned internally on the metrics against the corporate strategy and have driven consistency in the results. One of my big surprises, and I've been an analyst in supply chain for over a decade, is that companies tend to not have the linear progression of forward movement that I thought when I first started this work, I was very naive. Instead, what you're going to see is that each company has a fairly unique pattern, and there tends to be a lot of oscillation based upon what's happening in the business, either change in direction or change in what's happening in the business, mergers and acquisition, or changes in product portfolios. But I think we as supply chain leaders need to design the supply chain so that we can drive consistency in results and drive innovation in supply chain processes. And to me, the key is really balance and being a leader in managing the trade-offs. So as we have worked 2 years to mine this data, it is our belief that supply chains need to be resilient and predictable, balanced across a set of metrics that maximize value and show strength against year-over-year peer group. Now, this is easier said than done. This was our first representation of what we call the effective frontier, which represents the complex system. Companies typically want to drive profitable growth. They're balancing revenue and cost of goods, and they're managing working capital, and they've got new issues or processes that are happening with corporate social responsibility. And they've got to balance assets, their R&D strategies and their asset strategies. And typically, as supply chain leaders, we focus at the next line, which is purple, which is the balance of forecast accuracy, customer service, and inventory, as it ties to channel strategies, product portfolios, and supplier strategies, and how it ties to policies. Now, when I wrote the book Bricks Matter, what I wanted to do in understanding the complex system was to understand how companies had made trade-offs at these levels. I ran into several issues, and one issue is that companies may improve the forecast, but they may not use it. I found many companies that may have improved forecast accuracy, but hadn't really improved results because they didn't and weren't clear on how to translate forecast accuracy into actionable results. The second issue I found is there are not good sources for customer service data. Case fill is measured differently by every company I work with. And as a result, the sources of data for case fill cannot really be compared apples to apples across companies. We can get to inventory data off the balance sheet, but we can't get to some of the data we would really like to have, like what inventory is really working for us and what inventory has been written off. So as a result, while conceptually we believe this is the right model, because we couldn't find the data, we started working on another model, which we call the supply chain effective frontier. Now, yes, I took a lot of business classes as an MBA at the Wharton School, and I am deliberate to not call this the efficient frontier. And the reason for that is I don't believe that the efficient supply chain is the most effective. In fact, what we see is most companies have not made improvement in operating margin and inventory turns, but they have made a lot of progress on revenue per employee, making the supply chain much more efficient. So what we wanted to understand was how had companies balanced growth, profitability, cycles, and complexity, and how had companies evolved? Because what we have found is that companies will often make small progress at the intersection of profitability and cycles, but then they're not able to sustain it. And so we find that 9 out of 10 companies actually are stalled at year 2 or year 3 of a program, and they're not able to make progress, and they'll oscillate between operating margin and inventory turn going back and forth. And one of the barriers is that a lot of companies, even though we've invested a lot of technologies, cannot get their hands on supply chain cost data. We're still having a volumetric discussion, and not all companies are aligned to have a discussion with the finance team or to take supply chain to the corporate board level. And that's one of the things that we want to help supply chain leaders to do. And so as we present the data, often we'll have discussions where people will scratch their heads and they'll say, what do these financial ratios mean, Laura? What are days of payable and what are days of receivables and what is inventory turns and, you know, what is the difference between operating margin and gross margin and cost of goods sold? And our research is really focused on what are the metrics that matter and why. Because today, what we find are today's supply chains, if we look at the data, and this is from a recent study, they're cautious, they're reactive, they're traditional, they're inside out. And most companies say there's a lot of room for improvement. But they want agility, they want alignment, they want to be able to manage global supply chains. And unfortunately, we've built tightly integrated supply chain that are inside out, not outside in. And so we can't be responsive. You know, the tightly integrated, very efficient supply chain is not able to really balance the effective frontier. And it's a business continuity risk. So in the report that we published today, where we look at what are the risk factors for 5 years ago versus the future, and we asked supply chain leaders, and this was from a recent study that we just did, about what are the risk areas. You know, we know supply chain risk and product quality are issues. We've been working on it. We know we've got geopolitical issues. We've been working on it. But the areas around operations complexity, demand volatility, supplier viability are new and they're growing. And those issues cannot be solved by driving it from inside out. So why is this important? We must be able to have a board-level discussion to change the discussion from inside out to outside in to be able to drive the performance that we're going to talk about today on the Supply Chain Index. So the Supply Chain Index will be a ranking of all publicly held companies for the period of 2006 to 2012. We are going to rank companies by industry at the intersection of inventory turns and operating margin, and George is going to talk a little bit about how we're going to do that. We're also going to rate them on at the intersection of return on invested capital, or ROIC, and revenue growth, and also looking at resiliency, which is the intersection of operating turns and operating margin, which we'll talk about and we'll define. And we will get peer rankings from the Shaman Circle over the summer, which will affect these rankings by 10%. Now, there are other methodologies in the industry that will compare very large companies and are much more influenced by peer rankings or analyst rankings. This is all about the numbers, all about the progress, very focused on industries, small companies to little companies, and goes across industries. So what will it look like? In May, we will publish our first report on the Supply Chain Index, which will go over the methodology for all companies. We will rank companies by NAICS codes, which will be major industries. So we will compare chemical companies to chemical companies. We will compare conglomerates to conglomerates, automotive to automotive. We don't believe you can put all companies in a spreadsheet and shake them up. And then we will look at the value of the company within that industry at the intersection of growth and return on invested capital for the period of 2006 to 2013, and we will stack rank them. So the company that did the best will get a ranking of 1. And then we will do the same thing for operating margin and inventory turns. We will stack rank them. The company that does the best there will get a strength value of 1. And then we will also rank companies by resiliency. And let me tell you what resiliency means, because it's a little bit more complicated. So the index will take 30% of the balance ranking, which is growth and ROIC, 30% of the resiliency ranking, which is the pattern at the intersection of operating margin and inventory turns, and 30% of the strength ranking, and will be influenced by peer rankings over the summer by 10%. Now, the period will be from 2006 to 2013. So, Abby, let's go through how we came up with the formula, and we would love to have people's questions on the formula as Abby goes through the work. Abby, you want to talk through a little bit about the history of the work that we've been doing together?
Sure. So we started back in February of 2012, and it was a very manual process. So I was using a Google search to look up Procter & Gamble's investor relations website, pulling the current annual report, and then manually entering the data into an Excel spreadsheet. And so that took a significant amount of time where we were just trying to find this data, and then we were able to organize the metrics into 4 different categories. So we've put those into the categories of growth, profitability, cycle, and complexity, and those align with the 4 different components of the supply chain effective frontier that Laura spoke about earlier.
So, Abby, we've done a lot of graphing of orbit charts, and I think it's really important that people understand what an orbit chart is, because we can't really have a discussion unless, you know, we can think about how to think about that pattern. In fact, I just got a question from Dave if we're going to do rankings year by year, or we're going to look at the whole period. And the key to this is really understanding the orbit chart. So why don't you walk us through this?
Sure. So this is an orbit chart that looks at Dow Chemical Company and their performance on inventory turns on the y-axis versus revenue per employee on the x-axis. And what you'll see is that I've marked the first year of that pattern in 2002 and then the final year in 2012. So if you trace that line, what you're tracing is their performance on a year-over-year basis on those 2 metrics. You'll also
go ahead, sorry.
Yeah, you'll also see in the upper right-hand corner of this chart, I've notated best scenario. So it can get a little bit tricky. Sometimes companies or people can get confused. Am I supposed to have high inventory turns or low inventory turns? What about cash to cash? And so in this example, you want to have both high inventory turns and high revenue per employee. So the best companies would be moving towards that upper right-hand corner over time. And to make it easy, Abby, you've put the stock symbol in the square for all the companies, because we're going to go through a number of companies. And we also have the average for the period, and the large diamond represents the average, correct? Exactly. So, you know, one of the things that was surprising to me, Abby, is we don't have a linear pattern here, you know, that it's actually gone back and forth. And, you know, when we first started these plots, you know, we had a lot of dialogue about, you know, a lot of people believe that we've had a lot of investment in technologies and processes and that we've created a lot better outputs. But, you know, what we see is that there aren't a lot of straight linear patterns. You know, can you talk a little bit about your experience in graphing these companies? How did you do it? Yeah, I think there has been a lot of investment, but when we take a little bit longer time perspective, so when we're not just looking at what happened between 2011 and 2012, but when we push that all the way back to 2002, people are surprised at how complex and how sometimes even chaotic those patterns can appear. And they're very different by industry, and so one of the things we worked with Arizona State on was a methodology that would allow us to look at resiliency, because when we looked at the intersection of operating margin and inventory turns, we saw in the metrics that matter reports that you've been doing, Abby, that some companies and some industries had wild swings. What did you learn through this? Tell the group a little bit about these reports. Right, so we've done 19 reports in the Supply Chain Metrics That Matter series, and you can see them on screen now. Most of them look at a single industry, and so trying to understand the patterns of about 4 or 5 companies within that industry. And I think what I've noticed, like Laura mentioned, is how different those patterns can be. If you compare chemical to consumer electronics, it's a very different world for those 2 industries as an example. And in fact, the difference is so great. You know, I had no idea that the differences would be this great, that I actually ran into George at the Informs conference, and I said to George, is there a way that Arizona State University could help us with how we map some of these patterns? So, George, are you on?
I'm here.
Okay, so, you know, when I talked to you about some of these crazy charts at the Informs conference, and I said, is there a way we can measure the pattern at the intersection of operating margin and inventory turns? Tell us about how you went about giving us a methodology to do that.
Well, it sounded like an interesting question. It's sort of a a measure of how tight the graph is when you think of it as a plot in space. And so we looked at some, kind of traditional, maybe some non-traditional kind of metrics. We looked at things like the maximum distance between the first year and the last year. We looked at things related, if folks are familiar with principal components analysis in maybe another life, that's a way of characterizing variability in say, two-dimensional spaces. And so we looked at measures related to those. Those are eigenvalue measures, as they're called, and they might be a scientific approach to the problem. But it turned out that although some of these other measures were reasonable, maybe a simpler approach just worked well and was easiest to explain. And that's when we looked at the mean distance between all the points in the charts, in one of the orbit plots, I should say. So if you go to an orbit plot, you look at all the points that are associated with one company, and you count the mean distance between any 2 points that are selected. That came up with a fairly nice measure of compactness, we might say, of that orbit plot, which is giving us that consistency measure that we were looking for. That metric is used within clustering analysis to measure the cohesion of a cluster. And so it makes sense that it would be a reasonable measure in this context as well.
So George, we looked at the industries, and we had 108 medical device companies and 133 points for consumer packaged goods and 209 for cereal food and 489 for pharmaceutical. And what we see are very different patterns in these industries. That medical device companies have a very tight pattern, but they're not very strong. They're not making a lot of progress, whereas consumer packaged goods have a tighter pattern and they're stronger. What do you see in this data?
Yeah, it was surprising how variable it was from industry to industry. Maybe we might have expected a few companies would have very different patterns from others because of the market environment and so forth. But actually, between industries, you could see the mean changes substantially. The median changes somewhat as well. So the typical, or the company that the score for 50% of the companies are below or above that median, it changes by a factor of 2 from one industry to the next. Then within an industry, you could see very large differences in the maximum and minimum columns. Some scores were as low as 0.2 and other scores were as high as 10,000 on the chart. So there was substantial variation. At least for some companies, the last column shows the standard deviation within the industry. And so, as Laura mentioned, the medical device manufacturing had a much lower standard deviation than someone like communications equipment at the bottom, which much greater standard deviation.
So one of the things we wanted to do was we wanted to understand this pattern and to look at what can it mean to companies. So what I'm going to do now is I'm going to take you through the industries, and I'm going to compare 2 companies on each of the industries, and then I'm going to show you the resiliency numbers, and we're going to actually show you the averages for the inventory turns and the operating margin. And then at the end, I'm going to compare companies so you can see the difference. So here we have Boston Scientific Corporation and Stryker. Both of them are medical device companies. And you'll see that not only is Boston Scientific not resilient, but it's not very strong. We're going backwards here with a pretty wild swing. This is not uncommon for us to see a company that has this kind of swing. And we think that, the reliability is extremely important at this intersection for supply chain leaders to deliver. Now, you'll notice that Stryker has a compact pattern, but they're not making a lot of progress. This industry we actually see is very resilient, but not making a lot of progress. So it's not very strong, but it's very resilient. And these are the resiliency rankings, just to give you an idea of what these values look like for the medical device industry. Now, as we go further and we compare, say, two consumer packaged goods companies, Unilever and Procter & Gamble, you can see that Procter & Gamble is much stronger in results for the period of time of 2000-2012 with higher averages, and also is more resilient. Now, Unilever in the last 4 years under the leadership of Pierre Luigi has done much better. But if we look at a longer period of time of 2000 to 2012, you can see a much wider pattern. Procter & Gamble has lost balance. They made progress on operating margin up until 4 years ago, and now they're going backwards in inventory. So the ability to have balance here is a conundrum for a lot of companies, and this is one of the reasons why we're working on this index. If we look at the resiliency rankings of companies within this industry, Colgate-Palmolive has the best resiliency. They're also very strong on year-over-year operating margin with 42 consecutive quarters of operating margin. Beiersdorf has tight resiliency, and then Procter & Gamble is a little further over, and then we have a lot of outliers with Unilever having a bigger number than Procter & Gamble. Now let's look at chemical. Chemical numbers are not as resilient as consumer packaged goods, and so one of the factors that's really important here is that we are able to look at the patterns. So these are all inventory turns versus operating margin, and again, Abby has marked all of these charts as the best scenario. And you can see that DuPont has some fairly major swings. When I talk to DuPont leadership team, they're like, this has changed, right? And so when I had a challenge back and said, don't we need to design the supply chain for resiliency at the intersection, the discussion got quite tense. Now, BASF actually is one of the most resilient chemical companies, and you can see, like most chemical companies, there was a swing coming out of the recession because chemical companies are further back in the supply chain with a poor visibility of the channel, but BASF has actually come back, and you can see that BASF for the period is outperforming DuPont. Now, when we compare the rankings here, you can see a pretty major difference here on the resiliency. If we look at food manufacturing, we can see that the food manufacturing companies are going backwards on operating margin. They've been hit hard by commodity prices. This is one of the reasons why we've got to compare companies within an industry. And in addition, you can see that there are some resiliency factors here. The food industry is not as resilient as consumer packaged goods. And one of the things that we see in these rankings is that the companies that have been more focused on a more limited product set and they do not have as much competition at the shelf. The cereal category is under a lot of pressure at the shelf with a lot of trade promotions, a lot of pricing activity, but those companies are a bit more resilient than you can see that the cereal companies are. Now let's look at consumer electronics companies. These orbit charts just make my head hurt, right? These companies are some of the very best planners in the industry, and they had to be. The inventory for consumer electronics has a decay rate based upon, when it's put in inventory, it quickly loses value. So this industry has gotten really good at inventory turns. But the management of margin has been a very tough thing for the industry. Samsung has actually done one of the best jobs in terms of strength, outperforming LG, and you can see here the numbers are quite favorable for Samsung versus LG, but we have a wide range of resiliency. So one of the things that we're studying is what is the impact? If we look at the strength of inventory turns versus operating margin vector trajectory, putting these together in the orbit charts, and we look at the trajectory for balance, what will that index look like as we bring this together for the supply chain index? So one of the things we see is that companies that are resilient, and we defined what resiliency meant, will often outperform their peer groups on the average. So here we have BASF versus DuPont. BASF has the same operating margin, but much tighter resiliency, and they have much better inventory turns, so they're able to have better cash to cash, despite the fact that they do not have the lengthening of payables that you see with DuPont. And in fact, one of the trends that we're seeing is that companies with the longer payables tend to have lower results. And so this is one of the things that we're studying is there an impact on the fact that we've pushed cost and waste back on the supply chain, back on our suppliers, and is this an impact on resiliency? We're not sure yet. That's one of the things that we're studying. The other thing we can see is that the companies that tend to be the most resilient also tend to outperform the peer group on the averages. So this is some of the stuff that we are actually looking at. Now, George, we have a question from a member and says, you know, if he was to use a t-test to compare the means between the different industries, would this be a good overall metric to compare the means relatively? What do you think?
Yeah, I think so. The means are going to be influenced by a few outlier companies. That's why we also calculated the median. But maybe you want to remove a few of the outlier companies, then you could use a t-test to compare the means. I think what you're going to find is because the sample sizes within each company group are so large that most all of those t-tests are going to be significantly different. So it becomes more of a question of whether the difference is meaningful from the business point of view or the supply chain point of view, rather than the statistical view, where you will get significance, I think.
Yeah. And, you know, one of the things that's been really tricky is, you know, that devil in the details with the outliers, you know. It's just amazing how many outliers that we have in the database. So Abby, any thoughts here in terms of what you see in these patterns or your key learnings?
Yeah, I think the point you made about the payables is something that a lot of people is new to them, and so, like you said, the research is ongoing in terms of trying to understand what impact that lengthening payables has, both on the industry and also on their cash-to-cash performance. Sometimes it can make their cash-to-cash performance look like it's headed in the right direction, but they're sabotaging that downstream network.
Yeah, and I find that, you know, it's the hard work really at the intersection of operating margin and inventory turns and the muscle behind growth and return on invested capital that really raises that potential and gets at the resiliency. So let's talk about what we're going to be doing, Abby, because this is work in process, right? So let's talk a little bit about what you're going to be doing over the summer and the research reports that we're going to publish. Because in May, we're going to publish the methodology report that's going to look at the strength and the balance ranking and the resiliency ranking. And then in June and July and August, on the countdown to the conference, we're going to have first in June a ranking of all consumer value networks, and in July we'll have the ranking of all the healthcare industries in the value network, and in August we'll have the industrial. What are your thoughts as you get ready to write those reports?
Yep, so instead of just looking at one industry at a time like we've done previously with the supply chain metrics that matter, we'll be looking across that value chain, and I think that will be more insightful for companies to understand how they can relate with their both upstream and downstream in those different value chains.
Now, George, one of the things we've been working on, and we're not done yet, is the correlation of this data to market capitalization. And, you know, we've done a couple of industries, and we find for CPG there is some correlation, but others there is not. Do you want to talk a little bit about that research and the work we've been doing?
Yeah. We've taken a number of these supply chain variables by industry group and tried to look at market capitalization as a function of that. Of course, that's, market capitalization is influenced by a number of factors, so you wouldn't expect that you're going to have a large proportion of the variability explained from only the supply chain, but we were hoping at least that there can be an element of market capitalization that we can see the effect of supply chain. We looked at year-over-year changes. We also looked at lagged variables. So we looked at, things like inventory status in the previous years and how that affects market capitalization in the following years, for example, because some of the effects may be delayed. In some industries with the high resiliency, we were able to get some relationship between supply chain variables and the models. It's not a strong relationship by scientific standards, but by economic standards, it showed some good relationship. This was in the form of a training versus test sample analysis, so we tried to be sure that our results were meaningful in that sense. The model, though, was complex, which indicated that the effects of the supply chain variables in combination are important. They're sort of, not well understood interaction effects that were required to really get any kind of signal from the model. Straight linear regression models that are sort of a mainstay couldn't detect the relationship at all. But the more complex models show a modest signal. R squared ratios currently of maybe 30% in that range, maybe occasionally a little higher for some industries. So it's an interesting project to push forward on this, and we hope to look at a few more industries and be able to summarize that a little better.
Yeah, so George, one of the questions we have is, what's the relationship of resiliency to company performance? And, I find it interesting that we are seeing some relationship in the correlations or the work you're doing between market capitalization and resiliency and the industries that are resilient. We won't know until we finish the work, but I find that trend to be very interesting.
Yes, and again, as we mentioned, it's not a strong relationship, but looks like there is a signal present, depending on the industry. It really has to be an industry that has high resiliency to begin with, are the only ones where we're seeing that kind of relationship.
Yeah, and I thought it was interesting in consumer packaged goods that, where we do have resiliency, that, there was like a year-one lag between inventory improvements and market capitalization. The complexity of the model I find to be very interesting.
Yes.
Can you talk, George, a little bit about the methodology you're using to do the work? Because it isn't a straight linear regression, which was the mistake we made last year trying to make it that.
Yeah, well, it's not that it's a mistake. It's just that it's probably more complex. We're using collections of decision trees. Decision trees try and partition or subdivide the companies on the basis of some of the independent variables. So if we look at inventory turns, what the goal of the model is to maybe use inventory turns to partition the companies into high market cap gains and low market cap gains. And then it continues. Other variables are used to continue to try and partition the companies until we could finally get the companies arranged in subsets that are fairly homogeneous for market cap. And we do that with a number of these splits, as they're called, and with a number of these trees in total. The reason we're doing this is because we're trying to capture some of those interaction effects among the predictor variables. It also allows us to look at either continuous numerical measurements or categorical measurements could be included as well. in the models, and that sort of makes it convenient. But it takes sort of this extra level of sophistication before we're able to detect that signal.
Which I think supports, George, it is a complex system, right?
Right. Right. Yeah, that would be one conclusion for sure that would come out of that modeling. Yeah.
Because, you know, I think most people are looking at these metrics in isolation in a spreadsheet, and they can't see the interrelationship, and they can't see the pattern. Let's see about the questions we've got. You know, I've got a question here. Why are we not using on-time delivery as part of the equation? And, you know, we would love to. We really believe in our heart on-time delivery should be there. But unfortunately, there's not an industry standard, an objective measure that we can use. Now, we are starting a benchmarking service where we will be working with company data, which will allow us to actually get into divisional data with the methodology and also look at the case fill data. But because everybody measures case fill or customer service differently, you really got to start with raw data and scrub it. So we don't have anything that can go across all these industries with case fill or customer service data. I wish we did, you know. We just don't trust the APQC data because it's self-reported, and we just don't have it. But we will be following that through a different service that we're offering on supply chain benchmarking. And if you're interested in that, we'd love to have a conversation about that. Another question I have is, what about looking at divisions? So we've got a number of companies on the line, Abby, that are conglomerates. They've got a lot of divisions. Can you talk a little bit about some of the work you've done of applying the methodology to divisional analysis?
Yep, so we've been able to do this same work on a smaller level under an NDA to look at the different divisions within a company to try to isolate some of those different characteristics of the divisions.
And, you know, we can't reveal those or share them, but it's amazing when we're able to look at the patterns. In fact, I had a conference room of about 33 executives from a finance team the other day looking at their orbit charts, and we were doing inventory turns versus operating margin and case fill versus inventory turns. And, you know, the head of finance turned around and said, this is so valuable to see these patterns. It's so different than the strategic consulting view of we can just reduce this amount of inventory. We can never take these measurements out of perspective of a complex system. We've really got to manage them together. So what I'm going to do now is I'm going to wrap up and talk about where we're headed next with this methodology, because we would love to hear from you. We're launching the methodology in May. We'll do our first report on the methodology, which will be a very cursory view of certain industries that we will look at, and then we'll be doing in-depth analysis over the summer months on the countdown to our global summit, where we will first look at the definition of the methodology. We'll fill in the blanks on strength and balance, and we'll publish resiliency, strength, and balance for a few industries with the methodology in May. Then in June, we have the Consumer Value Network report, where we'll be looking at the subsets of the companies in the Consumer Value Network. So we'll be looking at chemical, food and beverage, consumer packaged goods, and retail. Then we'll do healthcare. So we'll do hospitals, medical device, pharmaceuticals, and perhaps some chemical companies that feed into that particular value chain. And then the last one we'll look at are industrial companies. So we'll look at automotive, heavy equipment, the providers to that industry, contract manufacturers, communication equipment, and we'll see the differences of the value chain, because one of the things we want to do is put together the value chain. It's our observation that the further back in the value chain you are, the less resilient you are, the more you need to design to be able to absorb the issues at the intersection and swings of operating margin and inventory turns. And for that reason, I'm going to just kind of summarize some of my key learnings, and Abby and George, I encourage you to do the same. Is, you know, first of all, don't fool yourself by comparing companies within a spreadsheet. You've really got to compare companies industry by industry over a long period of time. I was doing the writing for the book Bricks Matter, and a supply chain leader said to me, Laura, no progress in supply chain happens in less than 3 years. It's got to really be in a period of 6 to 7 years. And the other thing I would say is don't fool yourself. What we see in the data is supply chain leadership happens in small increments. It happens in centimeters, not yards. So we see the leaders as making very small incremental changes. And they're reliable that, they design the supply chain for reliability at this intersection. And we also, I think, in the design of the supply chain, particularly as we talk about risk management, have got to think about those industries like contract manufacturing, which are not very resilient right now. There's a reliability issue. Third-party logistics, contract manufacturers are causing a higher risk to the supply chain because of the lack of resiliency. The small progress. Abby, your thoughts here as we close?
Yeah, I think the one thing that I would say is companies really have to start at the beginning to understand and make sure there's clarity on how this metric is calculated, and like I said before, do we want a high cash-to-cash cycle or do we want a low cash-to-cash cycle? What are the components within the cash-to-cash cycle that I can use to impact my performance on that metric? So really starting at a foundational level before trying to have those more complex conversations about which metrics do I care about, picking the ones that matter and how do I compare those against each other.
George, anything that you'd like to leave the audience with as you've looked at the data?
Well, I think the idea that it's a dynamic system, whatever metrics are used, you could see from the orbit chart that they're changing from quarter to quarter. And so with this longer-term comments that Laura made, it is important to try and take a little bit of a longer-term view, but also try and capture the idea of there is variability, even not only quarter to quarter, but from year to year in the metrics. And so you sort of want to keep that in mind as you sort of evaluate your performance over time. And that varies more or less by industry as well. So that's another element to keep in your thinking as you're looking for the relationship between the metrics and performance, and also the complexity of the relationships that we've seen.
Well, thank you, George. It's been wonderful working with you in Bahar, and we've got a couple of more studies that we're finishing up, and we're into the evolution of finalizing this, publishing our reports, and then George, you're going to join us at our Global Summit to share the insights, which I think will be so much fun because we'll show all the industries and then we'll really highlight, I don't know whether it will be 15 or 20 companies that have really done it the best. So we're hoping that folks will follow the work that we're doing. It'll culminate in the book that I'm writing, Metrics That Matter, that will publish in the fall. And it will also be part of the Global Summit that we're doing, where we're going to have a small group of 230 supply chain leaders that will be having discussions like this. We infuse it into our public training, and we ask many of our participants on our podcast to comment on some of the work that we're doing here. We'll continue with this webinar series through the summer, bringing you updates on what we're doing, because we think supply chain excellence matters. And we think that there has not been enough rigor in really understanding it, and it's unfortunate that 9 out of 10 companies are stuck in supply chain today. Thank you, George. Thank you, Abby, and we'll sign off now. This is Laura Cesari with Supply Chain Insights. Thank you very much.